Hello everyone, welcome back to Chill Trades, where I analyze stocks so you know what's going on. Tonight we're gonna be covering KPLT stock, which is Katapult Holdings. They've kind of skyrocketed the last few days after selling off, so we're gonna cover if they're a long-term investment or if it's just something to maybe play in the short term. And if you're here, if you haven't hit the sub button, go ahead and hit that. We've just passed 400 subs, which is amazing. I really appreciate it. So if you're here and you haven't subbed to the channel yet, please do. Get us to 500, that's the goal. And the goal is really to get to 1,000 before November 1st. So if everybody is coming to this video, hit sub. I know we'll get there quickly. That'd be much appreciated. But before we get started, the last thing I want to shout out is Jeremy Myers, who commented on the video. And everybody come on the videos because I really want to know your thoughts. You called this stock out and put it on my watch. I didn't know about it, so you get all the credit here. But let's go ahead and jump to the company. So KPLT, what are they? They're a buy now, pay later company, very similar to Affirm. And so that's why they first moved higher, is because Affirm said they're going to partner with Amazon. And so kind of a sympathy play. Everybody started putting their eyes on KPLT. And I think mostly because the stock is honestly really undervalued right now. And we're gonna break that down in a second, both the financial side as well as on the charts. But kind of looking more into the company. So what I want to look at is what they do, how they're different. So the main thing they're different is there's two different buyers. There's prime buyers and there's non-prime buyers. So non-prime buyers are people who are wanting to buy things online or in person, and they don't have as high of a credit score. They're what people consider a high risk purchaser, and those are the people that KPLT basically lends to, is the easy way to put it. And I really like this space, buy now, pay later, and it's really exploded over the last couple of years. One, because a new generation of people purchase different, and it's really a shift from buying things on credit card to buy now, pay later. And it's so powerful because when everybody knows this, credit card companies really charge you really ridiculous amounts of fees, like 30%. When you're paying something off on your credit card, and that really grows exponentially. You know, if you buy something worth $1,000 and it's at 30% of whatever you don't have paid off every month or something, that's an enormous amount. And so that's why people are switching to buy now, pay later, because the structure actually makes more sense to people. And so we're going to break down a couple things. So the first thing is Katapult's all by themselves in this sector of these more high risk, lower credit score borrowers, and they're by themselves, which is a big pro, because that means they have somewhat exclusivity to that audience, and there's a lot of people. I would say there's more people with lower credit score than with higher credit score, and so that audience is much bigger. On the flip side, there's more risk, but they're really hitting a market that nobody else is really focusing on right now. And one of the biggest calls, I would say, is that we see that their average order value of a good lease is $600, and they make 2x that cash price. So if someone buys something for $600, that person over, say, 12 months or 24 months is going to pay an additional $600 to Katapult for taking on that risk for them of basically being their leaser or their borrower. And so that's a pretty good money, 2x whatever investment they make. I would say that's a pretty good risk reward. On the con side, I think a reason why their average order value has been so big is because they came out and said that 70% of their business was through Wayfair. So 70% of people borrowing through them or leasing through them was through Wayfair. And we know Wayfair is home goods, typically items that are much higher priced. And so this is the biggest con, I would say, to the business is I really want to see them diversify the partnerships they have. If this company is able to diversify and kind of grow their network, this is going to be I would say, much more bullish for the company, because not only are they growing their revenue by expanding, but they're also making less risk for the investor. For me, it's like, oh wow, so your whole business is dependent on how Wayfair does. And Wayfair is a very niche of what they do, so it's dependent on Wayfair as well as home goods, how many people are buying home goods. And so that's like a really big risk, and I really want to see them over the next year if they can diversify their partners for their business. From there, after talking about the company a little bit, I want to dive into the finances. So the first thing I want to call out is that, we look forward P, they're at about a 7 P forward looking. This is amazing. This is a young company who's showing some profitability already, which is great to see. and we're going to see this continues. And when we look at kind of a holistic view of their earnings, when we look annually, 2020 was a big year, obviously because everything was shut down, and Katapult is focused on e-commerce lending, and 2020 was a big year for e-commerce, which is pretty amazing. And they also saw profitability, which is a big pro. When we come into this year, we saw March be profitable, but we saw June they didn't go they didn't have profitability, and so that's somewhat, I would say, of a red flag. And I would say the main reason is because we're seeing sales slow down across the board. We're seeing a lot of metrics come out on a macroeconomic spectrum that consumers are getting worried about the economy. They're getting worried about the Delta variant. We're seeing more variations appear, and so that means that consumers are trying to save their money because they're scared. And so there's a lot of things going on that could potentially damage the business moving forward, because we're seeing purchasing shift from goods back to services. The U.S. is a service-based economy, which is not good. And we're also seeing a slowdown in higher price purchases. So 2020, everybody got thousands of dollars from the government. And what people did is they bought expensive goods. They bought homes, money for down payments. They bought new cars, bigger down payments. They bought home furnishing, which is a bigger price point. And so we're starting to see people buy less higher price goods. It's a little slowdown. Still a lot of demand out there, but it's slowing down. Plus all the supply issues making costs go up. So consumers are a little bit worried on them, and we're potentially seeing starting to hurt their business, because in March we saw 88% growth, but in June we only saw 27% growth. So if their growth slows significantly, I really need them to see profitability. If a company is growing at 88%, 100%, I don't give a heck about net income, because I'm really buying them for their growth. But when I see a company growth substantially decrease quarter over quarter, that's 50% difference, or 50% less, I really want to see them net positive on income. It's really a trade-off. Either you're growing substantially or you're making money. Those are the two things, one of those two things I like to see. So when we go to their analyst estimates for their future quarters, this is where the red flag continues for me a little bit, is when we look at Q4 of this year, we see 82 million, but when we look at last year, it was 73. So that's only a 10% or $10 million more in revenue, which isn't a lot, which equates to, about 12-15% growth. So if we're seeing everything slow down to 15% growth, and we're not seeing really any growth in net income, that's a little bit of a red flag for me. And I understand, with all the revenue coming from Wayfair, with their revenue slowing, with the net income going negative, now we see why the stock went down to $3. I'm really curious what you guys think. Is there anything I'm missing in the analysis? Let me know in the comments. But those are the couple of the points that I'm putting together. I still think the company is extremely undervalued. They're about half a billion valuation. They're coming in a little bit under that in terms of revenue. But, if we compare them to a lot of other companies on the market, even Affirm as an example, their valuation is much lower. So all that being said, their valuation is still really low in the current marketplace. Next thing I want to look at is short interest, because the stock has moved violently recently, and I think that's partially due to their short interest. Obviously, when you see really big explosions, one, it's because they're oversold. Two, because they have maybe an elevated short interest and those people are getting squeezed. So I really want to pay attention to what happens over the next couple weeks for short interest. This is a site I use, Short Squeeze, daily updates on short interest. I really want to see if this goes up. If this goes up to say 20-30%, then I could see the shorts taking control of this and the price going lower. If we see this kind of fall off, then we might see some sideways price action, which is probably going to be honestly healthier for the stock. When we look at insiders and institutions, so institutions, they bought a decent amount in Q3. I like to see that. That means institutions are buying on the dip. One, they're either averaging down because the stock was at $10, or they saw the price go to $3 to $5 and they're like, this has to be a buy at this valuation and price point. The second pro is we're also seeing insiders buy. So these are people in the company and they've bought almost 300K worth of shares, and we're seeing C-suite buy that. This means the C-suite believes in the company. They believe it's great valuation. Typically in these SPACs that reverse merge and they're at these high valuations, they're selling their shares to make that money in that move. But we're seeing buying, which is a really big pro. I really love C-suite buying in shares in the company. That's a great sign. Lastly, I just want to look at the charts for the last 4 or 5 minutes. And so a couple things, big picture first. We did break above the 20-day, but that was off a gap above. And so we'll have to see, this is pretty big volume. When we go historically, we've never seen this big of volume. And so now that the Affirm news is slowing down, we'll have to see if volume if it comes off here. And if we see volume go significantly lower and we see short interest increase, then this stock could easily kind of reverse back down, at least fill this gap to the downside and maybe hang around $3. $3 honestly is pretty cheap for this company, a valuation perspective. And if I see this go any lower than $3, then it's definitely worth a consideration. We're coming up on the RSI back to 50, and we see a lot of rejections at 50. So if we can break above 50, come back and back test and hang up here, that's a really positive sign that enough new people found the stock, they believe it's undervalued, and we're seeing some purchasing going on. And then lastly, the Bollinger Bands for the big picture. So Bollinger Bands are really far apart, which is a pro and a con. The pro side, we're far away from the top of the Bollinger Bands, which means, if we're seeing bullish momentum like in the past, we can come up and test the top end of the Bollinger Bands off maybe a little bit more of a squeeze into the gap. The con, we're far away from the bottom side, which also means this could move lower. We do see the Bollinger Bands kind of decreasing pretty quickly together. So over the next week, I could see the lower end, around that $2, and we could see this decelerate down to this $7. So these are going to collide pretty quickly, and we'll see if we go higher or lower from here. When we go on the 4-hour time frame, let me go ahead and get rid of these Bollinger Bands. We're going to bring up a new EMA. I really want to know what you guys think of the stock. Do you think it's a buy? Is it a hold? Do you believe in the company? Do you think it's a great long-term play or just a short-term grab? Okay, so the first thing, 20 EMA. I actually want to go back to the daily first. So the daily, we do see the 100-day around the top of the gap. So if we do see a continuous momentum, there is a possibility for a squeeze if there's enough volume. If we continue to see, 50 million buys and sells in a day, then we could see a green, say 50 million on the green side. We could see a squeeze up to the top of the gap to the 100-day, but that is probably more unlikely. So let's go ahead and look at the EMAs, see where we're at in the RSI. So on the 4-hour candle, we are seeing RSI get up to this overbought territory. It's the highest it's ever been. And so we'll have to see how the stock responds from there. We don't have too much more room to squeeze to the upside based on the technical reading. And we did see a rejection off this big. When you see a big green candle like this, it's typically not a good sign. So we'll have to see how the charts respond tomorrow. We also see it, it closed above, it went above and closed above the 20 EMA, or this is 50 EMA, which is a good sign. That's very bullish. And when we go on the 20 EMA, we're above that as well. And the 20 EMA is curving up, which is a good sign. But if we do see this slow down, the 20 EMA is probably going to soften out sideways, and we'll have to make a decision from there. We do see the 100-day still decelerating pretty significantly, so that's not a great sign. And if we see a reversal here, we'll probably see the 100-day continue to decline to the downside. So we're really going to want to pay attention to those. I just made a weird noise in my mouth. We also have a gap here, which this is either gap and go. So if we have more big volume break above these, these resistance points, then that's a gap and go. The reverse is volume dies off and we see a gap closed. We close the gap to the downside. So those are a couple things. On the hourly, we're definitely got above, overbought. We're hanging above that overbought. We're staying above 50, which is a good sign. But the biggest negative is when we have big green candles, we have big red candles. So that means people are selling on these move higher. That means short-term action, or people who have maybe bought and they're like, I don't believe in the company. They're selling out on every opportunity. So this is not a great sign, and we saw that today. That could potentially lead to more red tomorrow. But these are all things we want to pay attention to. I like the move higher. I don't know how much higher we can move here based on what we're seeing technically. Some red flags, but this could be an amazing long-term hold if we get down to this $3 to $4 range again. I might consider it a buy, maybe start an entrance position because it is high risk, high reward, and if it breaks down lower, accumulate more shares. Appreciate you guys stopping by. Please like, please sub, and I'll see you again soon.